Okay, welcome to my favorite lesson of this entire course. This is the information that changed my life forever and really started to get me to think completely different about money and how we pay for things like major capital purchases. I went on to actually create an entire company around how to use this strategy to pay for college, which I'm going to go into more detail in Module 6. But in this module, we're talking about how to pay for major capital purchases. So in this lesson, I'm going to show you how to do that using what we call the private reserve strategy. Now, this could be used for paying for college, paying for, a wedding for your kids. This could be used for putting on a new deck or an addition to your house. This could be used for an investment to invest in, or this could be used for retirement. This could be used for any major capital purchase, which we know is that a major capital purchase is anything that you can't purchase with your typical monthly cash flow. So you're going to need to finance it. The question is, how are you going to finance it? Are you going to pay cash? Or are you going to use your savings, cash flow? Are you going to use somebody else's money? How are you going to fund this major capital purchase? That's what we're going to dive into. This is such a big part of this course that in this particular lesson, I'm going to break it up into part 1 and part 2. So this is part 1 of your private reserve strategy. In our next lesson, we're going to talk about part 2 of your private reserve strategy. This lesson is going to focus mostly on the concept to make sure that the concept is crystal clear. However, we are then going to need to know where to put our money to actually use this strategy. Once you understand the concept, we're going to look at all the different investment vehicles that could be used in your private reserve strategy. That will be in part 2, I should say, of this lesson. So let's dive into it. A strategy designed to help develop or improve one's financial position by avoiding or minimizing unnecessary wealth transfers where possible, and accumulate an increasing pool of capital, providing accessibility, control, and uninterrupted compounding. One of the most important concepts that I could ever possibly teach anyone is the idea of uninterrupted compounding interest. You're going to hear me talk about this a lot because one of the biggest mistakes that we make with our money is we spend it. We don't give it that ability to compound uninterrupted. So I'm going to really hound on this concept during this particular lesson. A fundamental key to the private reserve strategy or the private reserve account is that the money must be accessible through collateralization. Another very, very important word is collateralization. What does it mean to collateralize something? Well, when you buy a house, you get a mortgage. That mortgage is secured by the house. That's why the interest rates are so low, because there is a collateral position. You are using your house as collateral. Now, generally speaking, your house goes up in value. That's why it's a good collateral asset. All right, and that's why you get lower interest rates. Let's take a car, for example. When you buy a car, you're also using your car as collateral to secure that loan. If you don't make your loan payment, they just take your car. Your car is being used to secure that loan. If you go out and get a credit card and just swipe it to buy a big screen TV, you're not using your TV as collateral, right? Your credit card has no collateral. That's why credit cards are such high interest, because there's no asset being used to collateralize that purchase. For example, student loans, right? Any sort of college loan. A college loan tends to be a little higher interest rate than other loans because there's no collateral. You're just collateralizing by your future income. You're hoping that this college degree is going to get you a good job so you can make good money, which you could then use that good money that you make to help pay back those loans. But there's really no collateral. It's an unsecured loan versus a secured loan. A secured loan has collateral. An unsecured loan has no collateral. Another very, very important word. So 2 very important concepts here. Uninterrupted compounding interest being super important, and collateralization is another very, very important concept to understand. So some wealth transfers are avoidable, others you can only minimize. You finance everything you buy. You either pay interest or you give up the ability to earn interest. Every dollar not saved is consumed by transfers and lifestyle. So what is a wealth transfer? Well, we talked about wealth transfers in Module 1. A wealth transfer is where you transfer away money unknowingly and unnecessarily, meaning they're financial mistakes, or in other words, holes in your bucket that you don't know about. But it could also be something where we just need to minimize these mistakes. For example, income taxes. You can't avoid paying taxes or income tax, but you can minimize it through certain financial strategies. It's like paying for your house or getting a mortgage. We talked an entire module on mortgages, and you still need to buy a house. We're not saying you shouldn't buy a house, but how you buy that house could create what we call wealth transfers, meaning money that you're transferring away unknowingly and unnecessarily. Since you're buying this huge asset like this house, there's so much money going through your hands that making financial mistakes could be huge on a house payment versus a smaller investment of some sort. So these are all different areas that you want to make sure you've optimized these areas and either avoided these wealth transfers or at least minimize these wealth transfers. Okay, so before you make any major capital purchase, you need to understand that there's a cost to that purchase, but then there's also what we would call an opportunity cost, because it's not what you pay for, it's how you pay for it. So for example, let's say you want to put on a new deck, right, on your house, and it's going to cost you $32,000 for this new deck. It's not just the cost of the new deck, it's also what that $32,000 could have earned you had you not spent it on the new deck. Now, I'm not saying you shouldn't get a new deck. I'm just saying that the deck isn't just going to cost you $32,000. It's going to cost you what that $32,000 could have earned for your retirement. Same with college. You know, you're looking at two colleges. One college is in-state. It's going to cost you $100,000. The other college is private or out of state, and it's going to cost you $200,000 to $300,000 for college. Well, it's not just a $200,000 or $100,000 difference between the two schools. It's what that money could have earned for you in retirement. So it's not just the cost, it's also the opportunity cost. Now, I'm not saying that you shouldn't ever pay for anything. I'm not saying you shouldn't pay for college. I'm not saying that you shouldn't put on a new deck or that you shouldn't go buy a new car. I'm saying that how you pay for it is going to be extremely important because of that opportunity cost. Okay, so let's put some math to all of this. I know I've talked about a lot of concepts and some terminologies, but let's actually put some numbers behind it. So here we have two different ways to pay for something, this major capital purchase. The first option is, of course, we're going to look at our savings that we have and what it's currently doing. So we have this vehicle, this savings vehicle of $30,000. Now, you might think when I say savings, you might think of a savings account paying less than 1% at the bank. There are other savings vehicles, which we'll discuss in part 2 of this lesson, that can actually earn between 6 to 8% returns and still be considered safe and not be subject to losses in the market and everything else. So we're just going to use 5% in this example. So we're obviously not talking about a current savings account because the banks are not paying 5%. But let's say you do have this vehicle, this investment vehicle, that is earning 5%. Well, if we look at a 5-year window, and then we could look at a lot of different time frames here, but let's just start with 5 years. In a 5-year window, your $30,000 at 5% is going to grow to $38,501. All right, because you earned during that 5 years $8,501 of interest. Now we know from previous lessons and previous modules that if we borrow the money to pay for something at the exact same rate, so let's say we borrow $30,000 at the same 5% interest rate, that interest is going to cost us, right? We're going to have to pay interest on that loan to the lending institution that loaned us that money. We're also typically going to have to pay them a monthly payment. So if we look at this interest, this red graph represents the interest payments that we're paying on that $30,000 loan. you'll notice that your interest is getting smaller every year because you're paying down the loan. You're paying back these principal payments. You're making a $566 a month principal payment. So like buying a car, for example. You buy a car and you're going to pay almost $4,000 of interest over 5 years to borrow the money to pay for that car. But it's not just that. You also have to consider that the interest that you're making, the interest payments that you're making could have been earning interest at 5% in this vehicle up here, right? So we have this little yellow line, or this little yellow section, which is really hard to see over here. You can see it a little bit better over here, but this is the money that our interest could have earned. In other words, we're going to call it the interest on our interest, or in other words, the interest that we could have earned if we didn't pay that interest, okay? So if you borrow money from a bank and you have to pay them back the $30,000 that you borrowed, plus you have to pay them back the interest on that loan, that interest, all right, could have been earning interest, all right? So there's the interest at interest. There's also these principal payments. This $566 that you're paying towards paying back that loan could have been earning 5% interest. Had you been putting this $566 into this account up here, you could have been earning 5% on those loan payments. So there's what we would call an opportunity cost on the monthly payments. So that gives us what we call a total cost of ownership. TCO stands for total cost of ownership. So by the time we add our principal payments, the interest on our principal payments, as well as the opportunity cost on our principal payments, in other words, what our principal payments could have been earning up here, as well as what our interest could have been earning if we would have just paid cash. Now remember, even though borrowing $30,000 is going to cost you $38,501 over 5 years, that doesn't mean that paying cash is going to save you any money. Because by paying cash, if your cash could have earned 5%, your cash could have grown to $38,501. So you'll notice, and we've talked about this before, but you'll notice that to borrow the money versus paying cash for something, if the interest rates are the same, it is going to cost you the same. So if it's going to cost you the same to finance it versus draining your account and paying cash, would you rather pay $566 a month and give them just a little bit each month? Or would you rather give them your whole entire savings account? All right? Or would you rather hang on to your savings account in case of an emergency or whatever the case may be? This gives you more control. If you keep your money and just pay them that monthly payment, you're in more control of your money. Okay, so now let's see what happens if we drag this out over 20 years. Does it change anything? Well, yeah, it changes the numbers, but it doesn't change how you pay for it, right? $30,000 over 20 years could grow into $81,000 versus borrowing $30,000 over a 20-year window. Maybe you're getting a college loan and you're dragging that college loan out over 20 years. Well, that is also going to cost you $81,000 by the time you add up all of the 4 different things. Remember, there's your principal payments, there's the interest, and then there's the opportunity cost on what that principal and interest could have earned had you not been putting it here, but had you been putting it here. Because see, notice that we're not putting any monthly income into our savings vehicle up here. We're putting that money into here to pay down that loan. Now, this is going to blow your mind for a minute, and we're going to get into more details in the next lesson in part 2. But there are financial institutions that will allow you to borrow their money, right, and not make any payments. That means you could literally pay them back when you die. Now let me show you what this looks like. Let's say that we are no longer, all right, putting this 198 over here. Let's say that we're putting the 198 towards our investments up here. And let's say that we're actually earning a 6% return on our savings vehicle and only a 5% interest on our loans. And of course, we know that we're going to still, pay interest. Okay, so let's look at what's going on here. We've got our $30,000 that we're borrowing, but we're borrowing it at what we would call an interest-only loan, meaning we don't have to make payments. Okay? No payments being made. Now, how does that benefit us? Well, because we could take those payments and put it where we're earning 6% instead of against something that's only costing us 5%. Right? So now, over 20 years, we're still looking at this 20-year window here, right? Over 20 years, it's going to rack up $51,000 of interest. Now, for those of you who don't like debt, okay, that's going to freak you out. But remember, this is not debt because we have the money up here. If you look at your accounting sheet, your assets are greater than your liabilities. We could take this money and pay off this anytime we want. In fact, look at our account up here. Our account is $190,000 because we put the money towards the account that was earning 6%, right? So we still owe $81,000, but if we wanted to pay that off anytime, we could take some of the money from here to pay this off, and we would still be further ahead. So the key to getting further ahead is to earn a greater rate of return on your money, borrow the money at a lower interest rate, and put the money each month to where you're earning the most money. Does that make sense? All right. If you have any questions about this, remember, you can always reach out to us. There's a link to connect to our calendar. Book an appointment with us if you have any questions or you want to go over your specific numbers, because sometimes this can be complicated until you're actually seeing it for your specific example. But hopefully this makes sense. Remember, as a principal, you always want your money each month going towards where it's going to benefit you the most. If you could put your money towards something that was earning 6 versus something that was costing you 5, then put it where it's earning 6. Give yourself more access, more control over the money. Okay, so let's talk about the 3 different ways that you can buy something, that you can borrow something, and that you can pay for something. So first of all, we have the debtor. The debtor works to spend. That's it, right? No savings, earns no interest, and pays interest. So they just earn money and pay off loans that are costing them interest. Now, a saver saves to avoid paying this interest that the debtor pays. So they save, they earn interest, but they pay cash, meaning they give up the interest that they could have earned by paying cash. Now, a wealth creator is going to save and use other people's money. Maybe you've heard of Robert Kiyosaki or Tony Robbins or somebody talk about OPM, other people's money. The wealth creator saves their money and uses other people's money to maximize efficiency. All right, so they save, they get compounding interest, and they collateralize. There's that word. They collateralize their purchases. Think about it for a minute. If somebody has millions of dollars and they're going to go build an apartment building, and the bank is offering loans at 2 or 3%, are they going to take their money out of their investments that hopefully is earning a pretty good rate of return and pay cash to build that building? Or are they going to use the bank's money to fund the building of that building, right? And keep their money where it is compounding interest. And they may even use their money to collateralize the loan from the bank so that the bank doesn't have any risk, so that the bank will give them a better rate. Okay, so how about borrowing things? Well, the debtor is going to work to spend, okay? So they borrow money from a lender at the highest market rates. Have you ever heard car dealerships say, hey, we guarantee anyone, we'll approve anyone as long as you've got a paycheck? Why? Because they are using future earning potential as the collateral. And that's pretty risky right? What if you lost your job? Right? What if you're one of those that bounces from job to job and you're always unemployed? Well, that's going to take on a lot of risk, which means you're going to be paying the highest market rates because the risk is so high because your collateral is only your future income, not the greatest collateral position. How about the saver? The saver borrows from themselves. How do you borrow from yourself? Well, you just spend your money, right? Reducing current collateral position and resets compounding. You interrupt the compounding because you drain your tank. You spend your money. Now, what is human nature? Well, human nature is that when you spend your money in savings, let's say you have 3 months of income in savings and you feel really good about that level of savings. So then one day you have an emergency. You spend some of your savings. So what do? You rebuild your savings up to that 3 months of income level. But do you replace the interest that you could have earned if you didn't spend that money? Probably not. I don't think I've ever met anyone, because that's human nature. Human nature is that we don't pay ourselves back the interest that we could have earned if we hadn't used our money, right? Now, what about the wealth creator? The wealth creator saves and uses other people's money to maximize efficiency. They borrow from a lender at negotiated rates. Well, what does that mean? Well, if you have the money that could be used as collateral, then you can negotiate rates, right? You're in that power position because you have collateral, right? Using own money as collateral and continues to earn uninterrupted compounding. Super important right here. Everyone should be a wealth creator where you are using your assets to negotiate rates, all right? And you use your own money as collateral, all right? And you earn uninterrupted compounding interest. Now, let's talk about paying for things. How do we pay for things? Well, the debtor works to spend, remember? Makes payments to the lender at a highest market rate. So they're just, every month they're taking money out of their paycheck to pay that lender the monthly payment plus interest, right? What does the saver do? Well, the saver makes payments back to themselves to rebuild their account, right? So where they were before they purchased it, giving up the interest that their money would have earned. But like I said, human nature means that they typically don't pay themselves back plus the interest that they would have earned. They just drain their tank and then they refill their tank. Drain their tank, refill their tank. They don't actually get ahead. Now, the wealth creator makes payments to the chosen lender, allowing own money to earn uninterrupted compounding interest, maximizing the benefits of their private reserve account. All right, now let's put a visual to all of this. I want everyone to burn this image into their mind forever, okay? The debtor. This is what we call the zero line. The debtor lives below the zero line. They borrow for their first car, all right? They borrow for their house. They borrow for their kids' college. They borrow their entire life. They spend their entire life paying interest to a lending institution at the highest rates, and they never get above the zero line. Now, what about the saver? The saver lives at the zero line, right? They save to avoid interest. So they earn interest on their money, usually not very much because they're typically saving at the bank. Then they spend the money. Then they save and then they spend. Remember, human nature says they don't pay themselves back plus the interest that they could have earned, right? So they save, spend, save, spend, save, spend. They live at the zero line. They also don't get above the zero line. Now, what about this whole wealth creator concept? Well, the wealth creator actually earns uninterrupted compounding interest on their money, and then they use that money as collateral to borrow other people's money. Now, there may be a situation, for example, maybe you go out and take out some college loans to pay for college, and then you try to save as much money as you can into your savings vehicle, which you could then eventually use as collateral. But maybe for a while there, you're in debt, so to speak, because you owe more than what you have in savings. But eventually, you're going to have more money in your account than what you owe. And that's the ultimate goal, because you're going to have this uninterrupted compounding interest. Now, the other thing that I want to point out is, like I said, there are certain financial institutions, which we'll talk about in the next lesson. There are certain financial institutions that will allow you to borrow money using your money as collateral without making these loan payments. So instead of paying back, right, those loans, you could actually take your money to increase your compounding interest, creating an even bigger spread on the money. Because if this loan costs you 5% and you could earn, let's say, even 6 to 7% on your savings, then you would definitely want to make your payments towards yourself and towards your account that could increase that uninterrupted compounding. And then just have this interest-only loan without any payments. So those are a couple of different variations of this wealth creator concept. Okay, so we all know the problem with consumer debt. There's an obligation on your future earnings. You lose capital to purchases and financing costs forever. And you're a debtor to the creditor. And there's a loss of control of your money. Consumer debt is an inefficient purchasing strategy. The initial purchase is lost as well as the interest owed, causing further loss that can compound and spiral out of control. So, what is the solution? Well, paying cash, of course. Well, the problems with paying cash is that, first of all, to pay cash, you need to actually save the cash, okay? So you've got to build up your account. Plus, the other problem is there's this annual tax leakage, because every year that you save into this savings vehicle and add new money into this vehicle, you're paying taxes on the money that you're earning before you save the money. Plus, you must drain the tank, killing compounding interest. You lose control and the interest you could have earned had you not drained the tank. Okay, consider this. What if you could make the purchase without emptying the tank? Well, this would allow your private capital reserve to continue to employ the benefits of compounding. Well, you may say, well, if I don't use my capital, whose do I use? Well, you collateralize a loan from a financial institution, securing the loan by pledging a portion of your private reserve. Okay, so here's our private reserve strategy in action. All right, this is the visual. Over here, we have our private reserve account. We're going to get into the details of what this account looks like and which vehicle or which investment works best for this account into the next lesson, part 2. But for now, we've just got this account in general, okay? Just this generic account that is considered safe. We don't want this account to lose money, like if the market crashed or something like that. We don't want it to drop in value by 50% or anything like that. That would defeat the purpose. So for now, let's just say that the account is safe. All right, now over here we have our major capital purchase. We have a wedding, we have an education, we have a car. Maybe we want to put a new addition onto our house. Maybe we want to invest in a piece of real estate or in the stock market when the market crashes. Whatever the case may be, maybe we want to use this for our own retirement. Whatever the case may be, we may need to, at some point in time, borrow money from a financial institution. Now, when we borrow money from a financial institution, we could use our money as collateral. Here's that word, collateral. We're going to put a lien on our money, securing the loan from this financial institution so that we can get the best rates, right? Then we're going to get what we call an amortizing loan. What does that mean? Well, that means you have to make a payment, okay? So in order to pay back the loan for college or the loan for your wedding or your car loan or whatever the case may be, you're going to have what we call a structured principal and interest payment. That means that this financial institution, typically the bank is the most common, they're going to want a monthly payment. And if you don't make that payment, or if you don't make it on time, they all talk to each other and they're all going to know about it, and that's going to affect your credit. Okay? So this is the most common scenario right here. Okay, so you may find yourself in a situation where you don't have to use your money as collateral. Maybe you could get a 0% financing option on your car and use your car as collateral. Now you have all of this money available for other loans or other purchases without having to pledge some of that money as collateral, depending on your credit, depending on the vehicle that you're buying, and maybe the ability for that vehicle to be the collateral, whatever the case may be. But if you can avoid using your money as collateral, that's a good position to be in. Generally speaking, you're still going to have those interest payments or those principal payments as well, those structured amortizing payments. Now, the power of this strategy is that you continue to earn compound interest on collateralized funds. So even if you did actually use part of your money as collateral for this amortizing loan, the most important concept to understand of this whole private reserve strategy is that all of your money is earning the interest on your account. So whatever interest rate you're earning that interest rate on all of it, all of your money, not just this, right? Not just the part that's not being collateralized, all of it. Even the part that's being collateralized, the whole thing is earning that uninterrupted compounding interest. Okay, so there's this term we call collateral capacity. This is your capacity to use your private reserve strategy as collateral. Now, there's a few ways that you can actually increase this collateral capacity. First of all, you could add money to your account. The more money you save into your account, the more you're going to be able to use. You can see this green here, all right? If this part is already being used as collateral, you could increase your collateral capacity by adding more money to your account. All right? Second thing you could do is have that money grow. Maybe this earns interest, right? So all of a sudden your account is increasing in value, and that is giving you more ability to use as collateral. For example, maybe you use your house as collateral to get a home equity loan, and then the value of the house goes up in value really high, right? Then now you have more equity, or you have more ability or collateral capacity to borrow more money. Now, the third thing is what we would call lien reduction. If you pay off your loan that you had, then of course you're going to have more collateral capacity because you paid off that loan. All right, now there are several characteristics that we're going to want to look for in choosing an account to use for our private reserve strategy. In fact, this is such a big part of this concept that we're going to do this in part 2 of this lesson. So this is the end of this lesson. Hopefully you get the idea of this concept. Now in the next lesson, we're going to talk about various accounts that you can use in this private reserve strategy.